Dear ladies and gentlemen, dear colleagues in the first row and everybody joining us via live stream today, I all warmly welcome you at the Chamber of Labor, Vienna. My name is Lisa Meyer and it's my great pleasure to guide you through this evening because our topic is of urgent relevance and our guest, despite his young age, you hear it very often I guess, is a real luminary in his field and a critical economist of global renown. Gabriel Zucman is here tonight with us and we're very proud that he will speak about tax evasion, about how much money countries worldwide lose due to tax evasion and tax fraud, why this is a huge problem for a society and a just society especially, and what it takes to actively address it. Welcome, Gabriel Zucman. So great to have you here, and we're looking forward to your requirements regarding tax justice. And after Gabriel's presentation, my colleague Matthias Schnetzer from our economic department will contextualize Gabriel's remarks within the Austrian context and derive concrete demands for action against tax evasion and tax fraud. We plan to end this event around 8:30, and after that you are welcome to join our small gathering in the foyer outside. And maybe Gabriel can also take a moment to mingle there. So now I invite our chief economist, Markus Materbauer, to briefly introduce Gabriel and to delve a little deeper into today's topic. Please, Markus.
Ladies and gentlemen, it's a great honor to welcome Gabriel Zucman here at Arbeiterkammer. For Gabriel, it's actually an act of returning to Arbeiterkammer as he presented his book, The Missing Wealth of Nations, back in February 2015 in this very hall. The Missing Wealth of Nations was path-breaking work on the measurement of wealth hidden in tax havens. While Gabriel was a rising star in economics when he visited Arbeiterkammer in 2015, he now is one of the world's most prominent researchers on tax evasion among the rich and the multinationals, as well as on top income and wealth. Gabriel is professor of economics at the University of California in Berkeley, as well as at the Paris School of Economics. And last year he won the John Bates Clark Medal of the American Economic Association for the economist under the age of 40 who is judged to have made the most significant contribution to economic thought and knowledge. Gabriel's most important contributions to economics are firstly the combination of innovative research on measuring, on the one hand, how much wealth is hidden in tax havens, and on the other hand, how ownership of this wealth is concentrated in the hands of the few. Secondly, it's the combination of new and often unconventional data sources, from global investment data to distribution and national accounts to leaks from offshore financial entities such as the Lux leaks or recently the Dubai leaks. Gabriel's third major contribution to economics is the political relevance of his work. And I quote Emmanuel Saez in the current issue of the Journal of Economic Perspectives. It is hard to think of another economist whose academic research has had such a large impact on policy debates at such a young age. Gabriel's research is tightly linked with several important policy developments in tax policy. End of quote. Saez refers to the Common Reporting Standard as well as the global 15% minimum tax on multinational profits, as well as the 2% wealth tax for billionaires proposed at the G20 level. In 2021, Gabriel became director of the EU Tax Observatory, funded by the European Commission, which promises not only to monitor these developments, but also to build a framework for enhancing the international and European tax system. Since 2015, Gabriel has become one of the world's leading economists, and his political influence has increased as the international community launched major initiatives to reduce tax evasion. In Austria, however, political progress so far has been very small. Transparency is weak, political influence of billionaires is high, and taxation of wealth and inheritance is discussed intensely in society, but prevented politically. But change is in the making. In this year's general election campaign, tax evasion and a millionaire's tax play a prominent role. And it is so encouraging to know that one of the world's most prominent economists is on our side. So welcome, Gabriel Zucman. The floor is yours.
Thank you so much. Thanks for having me. It's such a pleasure to be here with you today. And indeed, you know, I was here 9 years ago to talk about my book, The Hidden Wealth of Nations. And in that book, I set out a number of proposals to try to better fight tax evasion by rich individuals and profit shifting by multinational companies. And these issues have been very high on the policy agenda ever since. And so what we tried to do at the end of last year with the Global Tax Evasion Report 2024 that I'm going to talk about tonight is essentially to take stock of what's been done over the last decade in terms of fighting tax evasion. What has been the reality of the progress that's been made? Has there been any progress? And what remains to be done? What are the emerging issues? And so we try to take a global perspective on this in this Global Tax Evasion Report. And 10 years ago, when I was here in this amazing place and with an amazing audience like tonight, there was still a relatively small community of scholars who were working in that area. You know, the study of wealth concealment, tax evasion. You know, some economists were interested in those issues, but not many of them. And today I feel lucky because there is a big community of scholars working in that area, a growing community with lots of young scholars all over the world who have taken up the challenge of conducting that work. In 2021, I created the EU Tax Observatory. We are more than 20 researchers working in that structure, which is primarily based at the Paris School of Economics. But when, in the process of writing the Global Tax Evasion Report, we counted more than 100 researchers active globally in that field of research. And so what we do in that report is to try to summarize all of that work. Our approach, as often, is data-based, is empirical, and the numbers, for those of you who want up-to-date statistics on, what's the amount of wealth, let's say, that Austrian residents own in offshore banks, or what's the amount of profits that are shifted by multinational companies out of Austria, and where do the profits go? Do they go to Ireland, to Bermuda, and so on? So all these statistics can be found on the Atlas of the Offshore World that we released at the same time as we published the report. Okay? Now, I'm going to present the main findings from this Global Tax Evasion Report 2024, but before doing that, I'd like to take a couple of minutes to ask, why do we need a Global Tax Evasion Report? Why is it important to take a global perspective on these issues? And the fundamental reason is this. If you study tax policy only in a domestic, in a purely national setting, this can lead to misleading conclusions. Because from the perspective of one single country, it can pay off to play the game of tax competition. It can pay off to try to provide financial opacity services to attract a bit of activity, a bit of wealth. It can pay off to be a tax haven of sort. And indeed, all countries have been going down that road to some extent. All countries are small relative to the world as a whole with globalization and have found profitable to, try to attract a bit of profit, a bit of wealth, a bit of tax revenue by becoming tax havens of sort. And the reality, the truth is that from a single country perspective, this can pay off in the short term. It can work. Look at a country like Ireland. If you look at the amount of corporate tax revenues that's collected by Ireland, it's about 5,000 euros per capita per year. Okay, so for a family of 4, that would be 20,000 euros of corporate tax revenue collected by Ireland, with a modest tax rate of 12.5%. For Germany, for France, it's a fifth of that. It's only 1,000 euros per capita, with much higher tax rates, of 25%. So it just, it can pay off. And so you might be tempted to say, well, look, it's good. It's good to be a tax haven. It's good to play the game of tax competition, except that all of that at the global level is a zero-sum game. Or even worse than that, it's negative sum, because the profits that are attracted by one country, or the activity that's attracted by one country, well, that's at the expense of other countries. So from that perspective, it's zero-sum. But in fact, it's negative sum from a global perspective, because what this tax evasion does fundamentally is that it fuels the rise of inequality. It primarily benefits rich people, the owners of multinational companies, the people who have hidden wealth in tax havens. And so it's worse than zero sum, it's actually negative sum. But to show that, you really need to take that global perspective. And so fundamentally, there is a need in the domain of taxation for an equivalent of the IPCC. We need an IPCC for taxation. You're all familiar with the Intergovernmental Panel on Climate Change, the IPCC, that tries to take a global perspective on climate change and the policies that could prevent it. We need the same thing for global tax policy. We need to be able to take a global perspective on the sustainability or the lack of sustainability of the policies of different countries. And at a very modest level, that's what we try to do with our little EU Tax Observatory, which we are going to transform into a truly global tax observatory last year, and maybe, far in the future, could pave the way for a kind of IPCC for taxation. Okay, so that's why it's important, in my view, to take this global perspective. And so now, if I try to summarize the main findings from our report, the Global Tax Evasion Report 2024, I would say that it's like in the famous movie. I'm sure most of you know it: the good, the bad, and the ugly. Okay, so I'm going to start with the good. The good is that we have made some real progress in fighting one form of tax evasion, which is the concealment of wealth in tax havens. Rich people who have bank accounts in Switzerland, in the Cayman Islands, and so on. Before 2017, 2018, there was an almost complete bank secrecy. It was very easy for rich people to hide assets in those countries with traditionally very strict bank secrecy rules. And that's the story I told, for instance, in my book, The Hidden Wealth of Nations. And then, that tax evasion had very important costs in terms of lost tax revenues, in terms of inequality, and so on. And then, in my book, The Hidden Wealth of Nations, I had called for, many others had also called for, a new form of international cooperation, which was the automatic exchange of bank information. What we said back in the days was, look, banks in tax havens should be forced to share their data automatically each year with foreign countries' tax authorities, such that these countries can properly assess the taxes that are owed by the clients of those banks. Now, it turns out that this has become a reality. In 2017, 2018, more than 100 countries have started to implement such an automatic exchange of bank information, including all the key offshore wealth management centers. Well, that's really quite striking. What the graph here shows is try to provide the first quantification. So it's an emerging body of research that tries to evaluate the effect of that policy. And so what the graph shows is, some attempt at answering the question, okay, what has really changed in practice? Okay, the regulations have changed quite dramatically. Now, what has changed in practice? The blue line shows the amount of wealth which is held in tax havens globally by households. And that has remained quite constant over time, the equivalent of about 10% of world GDP. But before 2016, 2017, almost all of that wealth was hidden in the sense that it avoided taxation. The income generated by that wealth was not declared by the corresponding individuals. 90% of that wealth evaded taxation. And then starting in 2016, 17, 18, with the gradual implementation of the automatic exchange of bank information, we estimate that today there is still some of that wealth which evades taxation, but only about a third, as opposed to 90% in the era of bank secrecy. Okay, so that's really pretty amazing because it shows that it's actually possible to make rapid progress in fighting tax evasion if there's the political will to do so. Or to put it differently, the goal of this is not to say, look, we've solved all the problems. Rest assured, in the rest of my remarks, I'm going to talk at length about the very big issues that remain. So the point is not to say, look, we live in the best of all possible worlds and tax evasion is a thing of the past. Not at all. But it's to illustrate a very important idea, which is that tax evasion is not a law of nature. Tax evasion is a policy choice. For many decades, we've tolerated this form of tax evasion, rich people hiding assets in Switzerland. And, policymakers said, there's nothing we can do about that. If some country wants to have very strict bank secrecy rules, that's their choice. We are powerless. And that's just a law of nature. But that is wrong. The choices that we made in the past are not the choices that we make today. We chose to tolerate, sometimes to facilitate this form of tax evasion. Now, collectively, we choose to fight it, and it makes a real difference. And I think it's a source of hope for the future, because it means that we should be able to make progress in other areas. So that was the good. But now, unfortunately, we have to turn to the bad. And the bad points to the lack of progress in fighting tax evasion by multinational companies. Okay, so tax evasion by multinational companies, what are we talking about? We're talking very concretely about, a company like Google. In 2003, just a few weeks before being listed as a public company in the New York stock market, they sold their own search and advertisement technology. They sold their technology to their own subsidiary in Bermuda. And between 2003 and 2019, this Bermuda subsidiary has made hundreds of billions, with a B, hundreds of billions in revenue, and dozens of billions of dollars in profits, taxed at a relatively modest tax rate of 0%, the corporate tax rate of Bermuda. And it's a striking example, but many other big multinational companies do it, and sometimes there's a view that, okay, this is only just the big tech companies that can do that because they have a lot of intangible capital that they can move to tax havens. But in fact, the data shows that that's not the case. This tax evasion also happens in the pharmaceutical sector, in finance, in manufacturing. It's an across-the-board phenomenon. And a lot of that tax evasion, I use the example of Bermuda, but in fact, a lot of that happens within the European Union. Okay, so globally, each year you have more than 1,000 billion euros in profits that are shifted away from countries like Austria or France or US, India, towards tax havens. And about half, or even a bit more than half of that 1,000 billion is shifted to tax havens that are in Europe. Ireland, Netherlands, Malta, Cyprus, Switzerland, Luxembourg, and so on. So that is what we're talking about when we talk about tax evasion by multinational firms. What the chart shows is how much this tax evasion costs us in terms of lost corporate tax revenues. And the answer is that this tax evasion reduces global corporate tax revenues by about 10%. That's the number today. Back in the 1970s, in the 1980s, this phenomenon was really negligible. The loss of tax revenue was small, then it increased very fast in the 1990s, in the 2000s, and then it stabilized, the loss stabilized at around 10% over the last 5-10 years. A number of policies have been implemented to try to fight this form of tax evasion. So first, the OECD in 2015 launched the Base Erosion and Profit Shifting Project, BEPS, to try to curb that tax evasion. And then many countries tried to change their tax law. Most spectacularly, the US passed a big tax reform in 2018, where they cut their corporate tax rate from 35% to 21%, but at the same time, they introduced measures to try to curb profit shifting by US multinational companies. And what the chart shows is that in spite of these different initiatives, there is still the same loss of global tax revenue due to tax evasion by multinational firms, about 10%. So it doesn't mean that those policies had zero effect. Maybe absent those policies, profit shifting would have kept rising, its cost would have kept increasing. Maybe we would lose 15 or 20% of our tax revenues because of it today. So maybe one way to interpret the stabilization is that those policies are having some effect. But what is clear is that no matter what the effect of these policies is, it has not been big enough to reduce the scale of the problem. Tax evasion by multinational companies continues unabated. Now, in 2021, there was very high hopes when more than 140 countries agreed on a common minimum tax of 15% for multinational companies. I'm sure many of you remember that and are aware of that. It's really an important development. In fact, it's a landmark achievement in some sense, because it's the first time that there is an international agreement that puts a floor to how low tax rates can go. We have lots of international agreements about many things, about trade, even about tax, but they're always completely silent about tax rates, which is the most important aspect, of course, of tax policy. And here, for the first time, there's an agreement that says, look, for the profits of big multinational firms, there should be a minimum 15%. So at the time, I was quite excited about that. But a few years after, if we try to analyze the economic consequences of this agreement, I think it's fair to say that, unfortunately, it's a pretty big disappointment. And I'm going to try to explain why. So first of all, in 2020, 2021, there was a serious discussion about creating a minimum tax of 21%. In fact, it was in the program of then candidate Joe Biden when he ran for president for the first time. In his platform, he had a 21% international minimum tax on multinational firms. And at the beginning of his administration, he really, tried hard to push for that on the international stage. But very quickly, he gave up, other countries gave up, and agreed on a lower rate of 15%, which, of course, is very low, and unjustifiably so. In Austria, small and medium-sized companies have to pay 23% in tax. That's the standard corporate tax rate. So why should big multinational companies, the most powerful economic actors in the world, why should they be allowed to pay less than that? It doesn't make a lot of sense. But okay, that's the first problem. But at least you could think 2 or 3 years ago that even if 15% was low, there was the promise that at least it would be a real 15%. It would be comprehensively applied. And what has happened since then is that a number of exemptions and deductions have been introduced in the agreement to such an extent that the effective rate will, in effect, be much less than that. It's difficult to know exactly how much. Perhaps it will be only 10%, only 8%, but we are not, in fact, on the path of implementing a true 15% tax rate. So what are these exemptions? Now, I'm just going to talk about one, perhaps the one that's the most problematic from an economic and almost philosophical perspective. In the agreement, there is a provision that says that if a company has some real activity in a low-tax country, meaning it has factories or offices, it employs people in that country, then it is allowed to exclude the corresponding profits from the base of the minimum tax. Or to put it differently, the more you move production to a tax haven, the more you can avoid the 15% minimum tax and keep paying less than that, potentially as little as zero. This is perverse. This is absurd because it fuels international tax competition. Now, if I'm a multinational firm and I want to keep paying less than 15%, how am I going to do that in the future? Well, that's simple. I'm going to move more production to some low-tax Swiss cantons, or to places like Singapore, or to a number of territories where there is actual production going on, but that offer tax subsidies or preferential tax rates for multinational firms. And this form of international tax competition is a profoundly negative form of international competition. There are positive forms of international competition. Now look, when countries compete to have the best education system, that's good. It benefits most of the population. When countries compete to have the best infrastructure, that's a good thing. It benefits most of us. But when countries compete to attract activity by offering low tax rates, corporate tax competition, it's a profoundly negative form of competition, because again, the activity that moves to the low tax countries, it doesn't increase the global capital stock or the global level of activity, and it just fuels the rise of inequality. It just benefits primarily shareholders. So having an international agreement in 2021 or in recent years that's going to fuel this profoundly perverse form of international competition, I think is really a major mistake. This is, let me perhaps just conclude on that by saying that if there was, describing the chart, if there was a well-enforced 20% minimum tax on the profits of multinational companies, what the chart shows is that it would increase global corporate tax revenues by about 16%. That's a lot of money. If there was a well-enforced 15% minimum tax on the profits of multinational companies, it would increase global corporate tax revenues by 9%, still a decent amount of money. But after taking into account all the deductions and the exemptions, and I just mentioned one of those, you end up with the blue column that shows that according to our estimates, the global minimum tax is going to increase global corporate tax revenues by only 5%. Okay, so 3 or 4 years ago, we could expect 16%, and today we are down to 5%. Now, 5 is more than 0, but still, we should have done much better than that. And all of that is exacerbated by the fact that a new form of tax competition is emerging at the same time, so that what we are taking on one hand from companies, those 5% in extra taxes that they're going to have to pay, we are handing it back, and perhaps multiple times, by giving them subsidies in the context of the global subsidies race for global green energy that has emerged over the last few years. That's one of the most important policy developments of the last few years. It all started with China giving subsidies to Chinese producers of batteries and green energy and so on, and then the US responded to that with the Inflation Reduction Act of 2022, which, as everybody knows, has nothing to do with reducing inflation, but which is just about giving subsidies to US producers of green energy. And then the European Union, which for a very long time had said that it's prohibited to give subsidies to companies, it's a crime. Then all of a sudden said, oh, look, we have to do this ourselves. We have to compete. The US wants to compete with China. Now we have to compete with the US that's competing with China and so on. And so promised to give a lot of subsidies. Subsidies, for companies, just like a negative tax. I'm a company, there's a 20% corporate tax rate. I make 100 in profit, I have to pay 20. If the government gives me 10 back, my true tax rate is only 10%. And so this race for subsidies, in some sense, is just like standard tax competition and shares the same problems as tax competition, the problems that I described in terms of inequality in particular. Now, of course, there is a crucial difference, which is that the subsidies are targeted to producers of green energy, so in principle, they should accelerate the transition towards a zero-carbon economy. So there is a crucial, very important, positive sum aspect to all of that. We absolutely need to dramatically accelerate the transition to zero carbon. That's the positive aspect. But the negative aspect is the way that we are doing this is by pitting against each other two very important objectives. One is the fight against climate change, and the other is the fight against inequality. Because by predicating the fight against climate change on policies like business subsidies that tend to be unequalizing, there is a risk that as we fight climate change, we are going to increase inequality at the same time. And pitting against each other these two very important objectives, the fight against climate change, the fight against inequality, is really at the core of our inability to actually make real progress in the fight against climate change. We need to fight it with policies that are going to reduce, not to increase inequality. And there are many such policies. There's public ownership of certain sectors, of certain industries. There is massive public investment in infrastructure. There is new forms of international cooperation to invent. This is how, in the past, we have fought existential civilizational challenges. Not by giving tax credits and subsidies to businesses. But today, the way we approach that issue, unfortunately, is with primarily tax breaks for companies. Okay, so that was the bad. But now we have, unfortunately, to turn to the ugly. And the ugly is this picture. So the ugly points to the fact that we have not started yet to address what's the main issue in our tax systems globally today, which is their profoundly regressive nature. And I wish there was a line for Austria that I could show here. But here I'm just showing the results of 3 really high-quality studies that have been conducted for France, for the Netherlands, for the US, that follow the same methodology. And what those studies try to do is to allocate all taxes to individuals, all the taxes in the economy, so the individual income tax, but also sales taxes like the VAT, the corporate tax, property taxes, everything. You allocate all taxes to the different groups of the population, and then you compute for each group of the population what is their actual effective tax rate. So P010 on the x-axis denotes the 10% of individuals with the lowest income. P1020 is the next decile. And then there's a zoom towards the end on the very, very rich, the super rich, all the way up to dollar billionaires. Okay, so you rank people by their income and you consider billionaires as a top group at the very end. And on the y-axis, you have the effective tax rate of these groups, so meaning the total amount of tax that they pay divided by their income. Okay? So let's take the case of France. Very striking. France is a relatively high tax country overall. The amount of tax that's collected by the government is more than 50% of national income. So unsurprisingly, all the social groups, more or less, have to pay a lot of tax, around 50%. Some of them pay 45, some 50, some 55, but everybody, almost everybody in a country like France pays a lot of tax. With one exception, the billionaires see the dramatic drop to 25%, down from 55 to 25%. And that's counting everything. That's counting all the taxes they pay, including all the taxes that the businesses that they own pay, which are fully allocated to the owners of the companies. Okay? Dramatic decline in tax progressivity. You see that in the Netherlands as well. The decline starts a bit earlier in the income distribution. You see that, but less extreme in a country like the US. And so, where does this come from? Well, what's the problem? The problem is that our tax systems, in principle, what is supposed to ensure some level of tax progressivity is the individual income tax, which has a progressive rate schedule. But the problem is that billionaires pay very little or sometimes zero income tax. So, for instance, you had revelations, a number of spectacular case studies a couple of years ago in the US, when you had revelations by the US media ProPublica about the tax payments of the wealthiest Americans. And so in those revelations, you see people like Elon Musk or Jeff Bezos, in some years, paying zero, almost zero income tax. Why do they pay so little? It's because when you're very rich, it's easy to structure your wealth such that this wealth is not going to generate a lot or even any taxable income. And so that's how, in some years, Jeff Bezos reports no income. In 1 year, he reports zero income, and he says, oh, look, I'm so poor that I'm going to claim family benefits that are capped, to low levels of income in the US. And he receives, family benefits. He has zero taxable income. As CEO of Amazon, he didn't pay himself a wage, zero wage. Amazon doesn't distribute dividends, so as owner of Amazon, he received no dividends from Amazon. He didn't sell shares, so he didn't realize capital gains. So he said, look, I'm the richest person in the world. However, I'm really poor, zero income. So please send me a little check for my children. Anyway, so you had this kind of individual cases, but what the research has shown over recent years is that the problem goes beyond just a few case studies, and quantitatively is something that, as far as we can see, that's quite systematic. Okay, which brings me to the main proposal that we formulate in that report. And the proposal is very simple to understand. We need a coordinated minimum tax on the super rich. Just like there is a minimum tax on multinational companies, imperfect, as we've seen, but it exists. We need the same thing. We need an international agreement putting a floor to how low the taxes of billionaires can go. And 0, sorry, Mr. Bezos, is too low. So it has to be more than 0. The proposal that we formulated is that billionaires, dollar billionaires, should pay in tax each and every year the equivalent of at least 2% of their wealth. 2% of their wealth. That's the proposal. So let me walk you through it quickly. So first of all, it's only a very, very small population that would be affected by that. We are talking about billionaires. In 2023, you had 2,700 billionaires globally. So it's less than 3,000 taxpayers, really a tiny population. However, billionaires are very rich, they have a lot of wealth, about $13 trillion. That's the second column, the total at the bottom of the second column shows. And they don't pay a lot of tax today, so that forcing them to pay at least 2% of their wealth in tax, it would generate a lot of tax revenue, about $214 billion globally. Okay, so a tiny population, a tiny rate, and yet a large revenue potential. The revenue potential from this minimum tax on billionaires is actually larger than what we are going to collect with the minimum tax on multinational companies. So billionaires, there are very few of them, they really matter. And look, 2%, what is this? This is not going to change, this is not going to fix capitalism, to be clear. This is not even going to reduce wealth inequality. Why? Because the wealth of billionaires is growing at a rate of 7 to 8% on average per year over the last 30 years. Okay, so if you ask them to pay 2%, instead of growing 7 to 8% a year, it will grow 5, 6% per year. But average wealth per person globally is growing at only 2 to 3% per year. So that the wealth of billionaires, even with this tax, would, everything else equal, would keep growing faster than the wealth of the average person. So this type of proposal, I want to be very clear, wouldn't even reduce the share of wealth owned by billionaires. It wouldn't even reduce wealth inequality. It would just slow down the pace of the increase in wealth inequality. That's really not a radical proposal. That's not the spirit here. The spirit is we need to put a floor. It's a minimum rate. We ought to be able, collectively, globally, to agree on a standard, on a minimum rate. 2% is really not a lot. Okay? And then, of course, countries that want to be more ambitious could build on that and have higher rates if they so wish. But the important thing is, okay, let me just say one more thing. Let me just comment quickly on where the money would go. Because what the table shows is also, kind of a simulation of how much tax revenues would be collected by the different regions under one possible scenarios. And I emphasize that there are different ways that this money could be allocated, these tax revenues could be allocated to countries. One perspective is to say, well, the countries where billionaires live or where they have lived for a long time should collect the tax. Because after all, if you've become a billionaire in Germany, let's say, that's in part because you've benefited from education and healthcare in Germany, and so, Germany ought to get that money. So if you follow that logic, here is how much different regions of the world can get in tax revenue. So Europe would get 42 billion. North America, primarily the US, where there are lots of billionaires, would get 72 billion, and so on and so on. But that's only one possibility. There are another, at least equally valid perspective on who should get the revenue, which is the following. Billionaires, they derive their wealth from owning businesses that have access to global markets. And also their businesses, they emit carbon that contributes to climate change that affects all of us. So from that perspective, it would seem logical that at least some of the revenues should be allocated not only to the countries where billionaires live, but much more broadly to all countries. And you could even push that logic further. You could say, well, who's going to be most affected by climate change? It's going to be the poorest citizens of poor countries. So maybe that money should go in priority to the poorest citizens of poor countries. And so I hope that these issues will soon start to be discussed internationally. Because the great news is that we are perhaps at a historic moment. Perhaps something is finally happening on this issue. So this year, Brazil holds the presidency of the G20. And about 1 year ago, in preparation of their G20 presidency, they contacted us and they asked us, okay, what should we do? What should be the next stage of international tax reform? So there's been the automatic exchange of bank information, there's been the minimum tax on multinational firms, what should come next? And what we said is, look, what should come next is you have to tax the super rich, to create a minimum tax on the super rich. And so they put that on the agenda of the G20, and 2 months ago they invited me to make the case for such a tax, to present this proposal to a meeting of finance ministers, of G20 finance ministers in São Paulo, and something happened. Because most of the ministers and the countries represented basically first praised Brazil for putting that issue on the agenda. You have to realize that the G20 exists since almost, I think, 20 years or so, but never before, they meet all the time, never before had they discussed about taxing the rich, tax progressivity, inequality, what type of common policies could we implement to address those issues, which arguably are some of the most important issues that the world faces. But that changed 2 months ago, and most countries said, well, we praise Brazil for putting that issue on the agenda. It's high time that we actually have a conversation about that. And then, even more than that, some countries already have come out in support of this proposal. So that includes Brazil, of course, but also France, not a particularly left-wing government in France, as you may know, nonetheless came out publicly in support of the notion that we need to move towards such a minimum tax on the super rich. Spain, South Africa, Belgium have all already publicly expressed support, and more countries will pretty soon express support for that proposal. So there is real momentum. And let me just add that in the US, very interestingly, President Biden, in his own budget, has a proposal. It doesn't have a majority in Congress, so it's not going to be enacted anytime soon. But in his budget, he has a proposal that he calls a billionaire income tax, which is actually very close in spirit to our proposal. It's not 2% of wealth, it's 25% of income on a very, very broad notion of income. I'm going to spare you the details. But the logic is exactly the same. The rationale is the same, is billionaires have to pay a minimum amount of tax each and every year, just like school teachers and firefighters and you and I and regular workers, they pay tax each and every year. And so, there is this proposal in the budget, which was nowhere, by the way, in Biden's program when he ran for president in 2020. At the time, he was campaigning very much against proposals for wealth taxation that were defended by Bernie Sanders, by Elizabeth Warren. But then once he entered the White House, he changed his mind. And he said, look, yes, there's a problem. And we need to address that problem. So there is real momentum. Let me just conclude by saying two things. One, if I summarize the main idea from the report, the most important thing to remember from all of that is that tax evasion is not a law of nature, it's a policy choice. Some policies have been effective, the automatic exchange of bank information. Others are falling short, like the minimum tax on multinational firms, and yet others are still unaddressed, like the taxation of the super rich, although this hopefully might change. And let me just conclude by saying that the ideal, from my perspective, is always international coordination. You know, I am an internationalist at heart, and I also do think that those issues of taxing the very rich, taxing big multinational firms are better handled at a truly international level, just to prevent, you know, tax competition, you know, people or firms avoiding the tax by moving to a tax haven. But oftentimes, you know, that line of reasoning is used to argue that nothing can be done by a country alone as long as we don't have a global consensus. And so oftentimes, you know, that's how more, you know, conservative people justify the status quo. You know, I think most people, almost everybody, agrees that it's unacceptable for the super rich to have lower tax rates than the rest of the population. Everybody wants this to change, and there's overwhelming support in the population. Many opinion polls in many countries show that. But usually, what more conservative people say is, yeah, we'd like this to change, but we are just powerless, because you see, tax competition is a law of nature, and as long as all countries are not on board, there's nothing that we, Austria or France, alone can do. That view, however, is wrong. There is a lot that countries can achieve unilaterally. Okay, let me perhaps conclude by giving this one example of what a country could achieve unilaterally. Imagine that, and I'm sure it's going to play a very important role in the coming elections in Austria. Imagine that Austria implements a millionaire, you know, wealth tax, a wealth tax, progressive wealth tax with rates up to 2% for the wealth above 50 million euros. Okay. The debate is going to be all about whether the rich are going to leave. They're going to move to Switzerland. You know, they're going to move to some tax havens. It's going to be about that. But there is a solution to that problem. There is a solution that can be implemented by Austria alone, unilaterally. You don't need a global agreement. The solution is this. Austria should say, well, okay, you're free to move, but we will keep taxing you after you have left the country. If you've become very rich in Austria, number one, and number two, you decide to move to a low-tax country, and number three, you've spent a long time in Austria. So these should be the three criteria. You've lived for a long time in Austria, let's say 30, 40 years, we can discuss. You've become very rich, and now you move to a low-tax country. If those three criteria are met, Austria should say, we will keep taxing you after you've left, just as if you had not left. We will keep taxing you for a number of years. We can discuss 5, 10, 15 years. And the logic is straightforward. The logic is that if you've become very rich in Austria, that's at least in part, we can all agree on that, that's at least in part because you've benefited from education, healthcare, infrastructure, your businesses have benefited from public spending, and so there is just no natural right to move to a tax haven once you've become a billionaire and have nothing anymore to pay anywhere. That's just not acceptable. So this is an important illustration that there are unilateral measures. You don't need an international agreement to do that. You need the political will in one country to do that, to say this is the norm. And that can change profoundly the dynamics of inequality and the dynamics of globalization, because then it would become pointless for rich people, and you can apply that logic to firms as well, to move to tax havens, because it wouldn't change how much tax they have to pay. And so it would really kill, it would erase international tax competition. So this type of policy is really key to reconcile globalization and European economic integration on the one hand with tax progressivity and tax justice on the other hand. Thank you very much.
So thank you. Thank you. So thank you, Gabriel, for this very interesting presentation. Please stay here with me and take the seat in the middle. And we will now bring everything into the Austrian context and ask what we can do also in Austria to fight the tax evasion. So, and I am proud to welcome my colleague Matthias Schnetzer. Matthias Schnetzer is an expert in our Department of Economics, and he works on the topics of income and wealth distribution, on social mobility, political economy, and labor issues. Welcome, Matthias. Thank you. Starting with you, Matthias, having heard the presentation, do we know what we lose in Austria due to tax evasion? What is the extent? What is, how big is the problem in Austria? Have we any numbers? Have we any data?
I'm very grateful, Gabriel, to your for your presentation and also all those valuable insights from the Global Tax Evasion Report. And it cannot be stressed enough how much the work by Gabriel and the whole Tax Observatory has improved our knowledge and understanding of tax avoidance and tax evasion, in particular because you provide high quality and harmonized data for us. And one of those fantastic online services is, you already mentioned it, the Atlas of the Offshore World that is hosted by the Tax Observatory, and where you can find all those interesting figures also for Austria. And according to this source, roughly 10% of all corporate income tax revenues in Austria are lost due to the fact that multinational corporations shift their profits to countries with lower tax rates. And most of those countries are within the European Union and not in the Caribbean. So roughly 80% of those tax losses due to profit shifting from Austria goes to other European countries. And this alone amounts to roughly €1 billion in tax money that is lost per year. And here we are talking about undesirable but completely legal methods of profit shifting. Of course, besides the corporate income tax, there are also other taxes that may be legally or illegally avoided, but unfortunately we do not have that good data on this issue. In fact, we do have individual estimates from single research papers, and this research tries to quantify tax evasion in the shadow economy and in the offshore world, where by definition there is only little data, and even though some leaked documents brought some light into the darkness. So those numbers are, they come with quite some uncertainty, but let's look at the numbers. So those estimations suggest that 400 million euros a year are lost due to tax evasion for capital income. Additionally, 1.2 billion euros a year are lost due to tax evasion for labor income, and roughly 3 billion euros are estimated to be lost due to tax evasion and tax fraud for the value-added tax. So these are some examples. In total, recent research suggests that the tax gap, so the gap between taxes that are actually paid and taxes that should be legally paid amounts to roughly 12 to 15 billion euros a year. And that's a significant amount of money that's getting lost here.
So you said it's about 12 to 15, the gap between what is actually paid and what should legally be paid. So that's quite a lot in the Austrian context. So why is this such a big problem, Matthias? So what do we lose as a society if the multinationals and the super rich do not contribute sufficiently?
There are, of course, many problems for the economy, for society, and for democracy when taxes are avoided and when there is a lack of tax justice. I limit myself on 3 points here. So first, the welfare state currently needs solid financial resources to tackle current and also future challenges. We know that we now need public investments right at the moment to get the climate crisis under control or to solve the crisis in the caring system in Austria. So estimations say that we need an additional 70,000 care workers in the next few years and several thousand nursery school teachers in Austria. To afford the energy and mobility transition, there is an estimation by the Technical University of Vienna that estimates that we need an aggregate of 37 billion euros in public investment until 2030. Okay, so these are huge challenges, and that is why everybody must pay their fair contribution and not shirk their responsibility. And we simply cannot and do not want to afford tens of billions of euros tax avoidance. Second, the lack of tax justice might also undermine democracy. So if people perceive the tax system as unfair because they pay their taxes, but others don't, they might deem the system as dysfunctional or undemocratic. And there is evidence that exactly those people who feel treated unfairly or who feel disadvantaged, they do not exercise their right to vote anymore in an increasing number. And of course, there are many fold reasons for the abstention from voting, but one of those reasons is that there is a decreasing belief that this system is fair. And third and last, and Gabriel also mentioned it, tax avoidance is unevenly distributed across the distribution. Seminal work co-authored by Gabriel shows that tax evasion is mostly a problem at the top of distribution. And if the bottom 99.9% of the population pay their fair share out of their income, but the top, the billionaires, don't, or do to a lesser extent, inequality increases. This fuels wealth concentration, and so tax avoidance does not only reduce tax revenues that are so important for the social state, but they also impede the redistributional function of the tax system.
Interesting. So, Gabriel, we heard that if we do not really sufficiently fight tax evasion, we cannot finance the welfare state, we cannot fight the climate crisis. We have a problem with our democracy as well. So you pointed out that it's not a law of nature, that the super rich don't pay their taxes. It's a policy choice. In your opinion, what would you say are the, let's say, 3 most important measures that we can take? Is it taxing the super rich? Is it the IPCC for taxation? What would it be?
I think that number 1, unsurprisingly, it's this coordinated minimum tax on the super rich. I really hope that we can make quickly progress on that. You saw the picture, right? In France, Netherlands, US, everybody pays a lot of tax, but the super rich have lower effective tax rates than all other social groups. It's unacceptable. It can only fuel distrust with governments. The revenue losses at stake are really important, and it's best addressed, as I explained, through international cooperation. So number one, we need this minimum tax on the super rich. Number two, we need to build on the minimum tax for multinational firms that we have and make it much better, okay? Its virtue is that it exists. It has the loopholes that I mentioned, but it has a very low rate of 15%. But any country or group of countries could say, well, look, for us, we are going to choose a higher minimum rate. We in Austria, we think that the rate, should be no lower than 23%, what our small businesses pay, and so for us, it's going to be 20 or 25%. And you don't need unanimity or consensus to do that. I want to emphasize that it's not because you have an international floor that all countries have to converge to that floor. All the countries that want to be more ambitious can do it, and they should do it. Then number three is it's important beyond those two minimum taxes to reintroduce real progressivity in our tax systems by reforming the income tax and recreating progressive wealth taxes. So the progressivity of the income tax has been undermined in many countries over the last decades because typically in many countries capital income is taxed at lower rates than labor income. The reason why countries have felt that they had to do that is because they thought, well, it's so hard to tax capital income. The wealthy can easily move their wealth, taking again tax evasion as some kind of law of nature. They felt that the only possible answer was to cut the rate, when the right answer is to say, no. Let's fight the tax evasion. Let's close, these possibilities of wealth concealment, and then you can increase the rates. And then, of course, and I'll conclude with that, the debate that's happening and going to happen in Austria about progressive wealth taxation is probably the most important debate of all. Because in the minimum tax and the super rich that I presented, it's just on billionaires, it's a tiny population, but there's no reason to tax just billionaires, right? It makes perfect sense to complement the income tax with a progressive wealth tax. And here, it's going to be essential to learn the lessons from the past. Austria had a wealth tax before 1993. Many European countries have experience with wealth taxation, but they did it poorly. Those wealth taxes essentially exempted the super rich. There was no effort at fighting tax evasion. There was no effort at fighting tax competition. Wealth was poorly valued, poorly measured. It led to all sorts of inequities. We need to draw the lessons from those mistakes and recreate wealth taxes where all assets are valued at their correct market value. There's no exemption for anything, no matter what type of assets you own. That should be subject to the tax. And in exchange for that broader base, you can start higher in the wealth distribution. The goal shouldn't be to tax people who have a primary residence, who have less than €1 million. It should be to tax the very rich, and we can discuss what this means, but people with several millions or dozens of millions, and with graduated rates that rise with wealth. That is really the most important policy in my view.
So we heard that taxing the super rich is one of the most important things of all times, maybe. Coming back to you, Matthias, there are several initiatives we heard about that have an impact, but you can also have an impact unilaterally. So what would you say, looking to Austria, what are the most important steps to be done in Austria?
Yeah, unfortunately, Austria has gone in the wrong direction in many ways, I'm afraid. So I would like to approach this question by showing what Austria should not do or should not have done. So first, do not default on directives from the European Parliament, at least the sensible ones. In 2021, the European Parliament has adopted a directive for more tax transparency by requiring multinational corporations to publicly report in which European countries they generate profits and in which country they pay their taxes, the so-called country-by-country reporting. And the single member states were actually supposed to implement this law on a national level by June 2023, so 18 months after the adoption of the directive on the European level. Now we're 1 year later, and still Austria has not passed this law for more tax transparency. So we missed the deadline. Rumor has it that in one of the next parliamentary sessions in Austria, this law will be passed, so we are waiting for it, so we'll see if this is happening. Second, do not participate in a harmful downward tax competition by reducing corporate income tax rates. And this is what actually was happening in Austria right recently, where the corporate income tax rate was reduced from 25 to 23% in the last 2 years. And this has already cost us €1 billion right now, and the beneficiaries are the large corporations. For instance, the Austrian banking sector has reported all-time high profits in the last 2 consecutive years. And due to the tax reduction, they have additionally saved more than 100 million euros that should actually be paid in taxes, but they don't have to because tax rates were cut. So those are the beneficiaries of this reduction. So the demand is simple: just revert the tax rate cut back to a level that, by the way, is also mentioned in the Global Tax Evasion Report as sensible level, which is 25%. Third, do not reduce tax audits. The number of staff positions in the Austrian tax administration has been cut by roughly 20% in the last 2 decades. Auditing activities have declined by almost 60% in the last decade. Moreover, there has been a task force that was specifically aiming at high net worth individuals, so the super rich, for auditing activities. And this group was dissolved in 2018. It only existed 2 years, and they made a huge profit in tax revenues in those 2 years. And moreover, 70% of all private foundations in Austria have never, ever been audited. So we need effective controls and penalties for tax evasion through sufficient auditing activities and also through sufficient staff positions in the tax administration. Last but not least, do not reject wealth taxes. There is no other Western European countries where wealth concentration is as high as in Austria, while wealth-related taxation is as low as in Austria. And this wealth concentration comes with several economic, ecological, and social consequences. So many initiatives and also supranational institutions are calling for higher wealth-related taxes in Austria. The majority in the population is in favor for such taxes for the super rich, and even the wealthy, or a couple of wealthy themselves, organize themselves in initiatives like Tax Me Now and say we want to pay a fair share of our tax. So, and the last or latest endeavors by the G20 that was incited by Gabriel and also, as he sits right here, Quentin Parinello, his senior policy advisor, is very welcomed here. They give the whole discussion a new momentum and they create a new dynamic. So now is the time to push forward for wealth taxation.
Thank you, Matthias. So coming to the end, the last question to you, Gabriel. Please give some very concrete suggestions to our Austrian policymakers. They do need your help.
Look, I think that I want to start by emphasizing again the idea in my conclusion that you shouldn't be afraid of the threat that rich people are going to agitate to leave the country for tax reasons. Because it's true that some wealthy people, they favor more taxes for wealthy people. But most wealthy people, they favor lower taxes for wealthy people. And they have a particular hatred for wealth taxation. They particularly dislike the wealth tax. And they have good reason to dislike it. It's because this is the one tax that can actually work to tax them. And so they really are willing to fight it. In practice, the main way for them to fight it is to say, look, if you try to have a wealth tax, we'll just move. We'll go to Switzerland, we'll go to whatever. And so my main advice is, this is, you have to prepare for that debate. And I think, there are different answers that can be given. A standard answer that progressives, like to give is to say, oh, well, look, you always threaten to leave, but at the end of the day, you don't do it. Very few people move. And that's quite true. It's when you look at, and there are careful studies that have been conducted, for instance, that looked at wealth tax reforms in Sweden and Norway and Denmark, and the impact and the mobility of the super rich. What researchers find is that the number of very rich people who actually move to tax havens is really quite low. But I don't think that's the best answer, because in the public debate, the threat really can carry the day, can really influence the voters. I think a much better answer is to say, look, you can move. You're free to go wherever you want, but you will have to keep paying taxes in Austria for at least a few years. And it's a relatively novel idea. There's no country that really does that at the moment. In fact, you have two polar cases. You have, on the one hand, you have the US that has what is known as citizenship-based taxation, meaning that if you were born in the US and so you have US citizenship, you're supposed to pay taxes in the US until you die, even if your parents move out of the US when you were 2 months old and you never set foot again in the US. Okay, so even if you never spend only 2 months during your life in the US, you have to pay taxes in the US for your entire life. That's one model, which is extreme in one direction. But you have to realize that what all other countries do, like Austria, France, all other countries do the exact opposite, which is that if you've spent all your life in Austria and become very rich there, now you decide to move to a tax haven, then immediately on January 1st of next year, that's it. You have no tax to pay anymore in Austria. And that's extreme in the opposite direction, and that's also very, very bad. The right system is a middle ground, where taxes should continue to apply if you've lived in a country for a long time. Citizenship shouldn't be relevant. What matters is whether you've spent a long time in a country and whether you've become very rich in that country. And you don't want to burden people, students, middle-income people with having to pay taxes after they've left Austria. That's not the point. It should be only for rich people. But that's the right approach. And let me just mention that I think the reason why this has not been done in the past is because it was hard to track the wealth and the income of non-residents. Let's say someone moves to Switzerland, because there was no exchange of bank information, it was very hard for Austria to say, look, we are going to keep taxing you. But now we can build on the automatic exchange of bank information. And we can ask Swiss banks to report information about the former residents of Austria that the Austrian tax authority could use to pre-populate an income tax return, a wealth tax return, send it to the person and tell them, look, this is what you have to pay. So that's my main, very concrete advice. And I have presented that report in a number of countries, and everywhere I go, I try to convince, people, policymakers, and civil society in that country that we need one country to do it, to demonstrate that this is feasible. Now it has become feasible, and you will see that as soon as one country does it, very quickly other countries will follow suit. And I bet that, I don't know if it's in 5 or 10 or 20 years, but this will become the global norm. But we need one country to show the light, to pave the way. So, my call tonight is let it be Austria.
Would be a good thing, I think, and we hope Austria makes that move and follows the money, as you prescribed. So let's sum things up. We have a lot of data about tax evasion. We know what we lose when we do not tax the super rich, the multinationals, the billionaires. We know what society's problems will be if that money is not available for all of us when it comes to welfare, democracy in general, the climate crisis, and so on. So there are no excuses. We know what works. We know what measures do work and what do not work so well. So the time to act is now, I would say. And I hope we will all be part of that change. So thank you for coming here tonight. Thank you for joining us via live stream, and you're invited to join our little gathering outside in the foyer. Thank you, Gabriel.
Thank you,
Matthias. Thank you, Markus. And wish you a pleasant evening and goodbye.